Welcome to our deep dive into one of the most critical concepts in finance, the cost of capital. This is essential for every business making investment decisions. Let's start by laying the groundwork and understanding what the cost of capital truly represents. The cost of capital, or COC, is the minimum rate of return a company must earn on a project in order to increase the firm's value. Think of it as the price a company pays to secure funding. Businesses calculate the cost of capital because it serves as a critical benchmark. It's the hurdle rate that projects must clear to be considered worthwhile and add value for shareholders. The overall cost of capital is composed of the costs associated with the different sources of funding a company uses, typically debt and equity. Companies raise capital from various sources, mainly through issuing debt, selling common stock, and sometimes issuing preferred stock. Each source has a unique cost. To get a single representative rate, we use the weighted average cost of capital, or WACC. This factors in the proportion of each source of capital. Let's begin with the cost of debt, often denoted as KD. This is the effective interest rate a company pays on its borrowings. The cost of debt is essentially the interest rate on new borrowing, adjusted for taxes, since interest payments are tax-deductible. The tax shield is crucial. Because interest payments reduce taxable income, the actual cost of debt to the company is lower than the nominal interest rate. Next up is the cost of equity, or KE. This represents the return required by the company's investors on their investment. We typically use the capital asset pricing model, or CAPM, to estimate the cost of equity. This model links risk and expected return for assets. CAPM requires three inputs: the risk-free rate, which is the return on a riskless investment, beta, which measures the stock's volatility relative to the market, and the market risk premium. Finally, let's look at the cost of preferred stock, KP. Preferred stock pays fixed dividends, making its cost calculation straightforward. The cost of preferred stock is calculated by dividing the annual preferred stock dividend by the net issue price, which is the price after flotation costs. Now that we have the costs of all components, we can combine them to calculate the overall weighted average cost of capital, or WACC. WACC is the sum of the weighted costs of debt, equity, and preferred stock. The weights are based on the market value proportion of each component in the company's capital structure. By plugging in the calculated costs and their corresponding weights, you arrive at the WACC, the single rate representing the cost of all capital used by the firm. To wrap up, let's look at how this critical figure, the cost of capital, is actually used in business decisions. The cost of capital acts as the discount rate for evaluating investment projects, often used in net present value, or NPV, calculations and comparing with internal rate of return, or IRR, to determine project profitability. Understanding WACC is foundational for capital budgeting. Keep practicing these calculations, and you'll master this essential financial concept.